All right, good Friday afternoon, guys. Welcome to another edition of Loans for Homes. And today we are going to take a deep dive into condominiums. We've talked about this before, but stay tuned. We're going to dive right in. Welcome. I'm Heath Albritton alongside Justin Lee.
Yeah, I'm excited to be here. It's going to be good.
Kind of get to know us and who we are, how we do business. We're going to talk all things mortgage. We're going to try to cover everything, Justin. So,
Loans for homes.
Loans for homes. All right, so condominiums, Justin. Condominiums, guys, are a different animal, whether you know it or not. They are different. So if we were to put up a photo right now, Justin, of a townhome and a condo, and I ask our viewers to say, tell me which one is which. Do you think they could you tell the difference?
Nobody can tell by looking at it. How often do we need to go look up the deed, pull the property description, the tax record? And we do a lot of research on the front end. We're still not 100% sure if it's a condo or a PUD sometimes.
Yeah, and guys, honestly, realtors don't know either. It's a tough thing because, again, you can't look at it. They smell, look, and taste the same. And it's the legal description, how they're written up, whether or not you own the dirt underneath it, all of that good stuff. Now, PUDs, or townhomes as we call them, are treated just like any other single family home, whereas a condominium is treated totally different.
The rate's different, the terms are different, the investors we look at are different.
So it's always been more challenging, Justin, to finance a condominium than a single family home or a townhome. And the reason is, guys, first and foremost, is that there's a lot that goes on with an HOA, right? An HOA has to be very healthy, and it has to run itself properly, has to manage its finances properly. So we take a very deep dive into an HOA, and that's for our protection as the lender, but just as much for you as the buyer. And we want to make sure that this thing, and likewise, the agencies, and we're talking Fannie Mae and Freddie Mac here, also want to see how healthy that the HOA is. So up until this point, they haven't really made many changes, but we do have changes coming down the pike. The first biggest occurs on August the 3rd, so that's coming up, Monday?
Monday.
And right now, depending on the loan type you're doing, how much you're putting down, we either get a limited review or a full condo review. Now, the difference between the two, on a full condo review, we're asking more questions, right? We're taking a deeper look into it versus a limited review. Well, that limited review is going away effective Monday, so every condominium will have to have a full-blown review. So some of those things that may not have shown up before on a limited review are now going to show up on the full review. The next big thing occurs January the 4th of 2027. And Justin, I think this is going to be the game changer. This is the one that's going to make things really tough going forward. So each month, condominiums, the HOA, they have a budget. And right now, Fannie Mae and Freddie Mac require at least 10% of the budget be set aside for reserves. In case anything happens, they've got money set aside to make repairs or to do whatever it may be. That is going to 15% in January. And I don't think HOAs are ready for this because they're going to have to change their entire budget to reallocate this other 5%. And they may not want to do it just to satisfy lenders. But it's going to be tougher to get a loan if you're trying to do it. If you're trying to sell your place, it's going to be tougher. Because of this. And I think it's going to take a while, Justin, for HOAs to get on board, if they do it all, in order to do this.
Regardless, we're already taking, I'd say, 50% of our condos as non-warrantable or to investors that are portfolio loans. Fannie, Freddie have already pulled back. FHA has hardly ever approved a project anymore. So we're just going to see more and more condos falling into that portfolio space and that non-warrantable or condo tail space. So unfortunately, that's where the market's going, but we're here to protect you, and that's why we do all this research on the front end.
Yeah, and we're not telling you guys this to scare you away. We just want you to be educated. We want to be forthright. We want to tell you the truth and what to be cognizant of if you're out there looking. If you don't know, if I'm looking at a townhome or a condominium, just call us. We can look it up and tell you which one it would be. But also, starting in January and going forward, they're going to scrutinize things more, right? They're going to start requiring reserve studies to make sure that whoever's managing the account for the HOA is doing it properly, and that they are allocating a certain amount of funds where it needs to be. And that, therefore, the last thing we want is for a huge assessment to occur to a buyer down the road, right after closing, whatever it may be, or if your HOA fees increase astronomically to the point where you can no longer afford the payment. And guess what? If you can't afford the payment, foreclosure happens, and that's what lenders are concerned about. Also, condominiums, guys, if for any reason we have to foreclose on that, well, guess what? Again, as we just mentioned, it's going to be tougher to get a loan. The lender knows that. There's going to be less people that have a desire to buy a condominium than a single family home. So your audience to purchase that foreclosed property is going to be less. So just be, and as Justin said, we have non-warrantable products that will offset some of these things that Fannie Mae and Freddie Mac are requiring that can't be met. They are going to require a larger down payment, however, and a higher interest rate than a Fannie Mae or Freddie Mac deal will. So
Correct.
Once again, if you have questions on that, just call us. Condominiums are a different animal. And then also, guys, this week, the Fed Chairman Warsh spoke, and we'll let Justin touch on some of that, what came out of that meeting. Did they raise interest rates? What we can expect down the road. So Justin?
No, so the Fed didn't raise interest rates, thankfully, but the market didn't like it, actually, because the market's concerned with inflation. So the market tanked, 1,200 points yesterday. Yeah. And that was kind of the market rebelling to the fact that the Fed didn't seem aggressive enough on inflation. He also didn't give any forward guidance. He didn't talk about what they're going to do at the next meeting. He's just kind of waiting for all of his panels to come back with this different data so he can kind of get a better grasp and more accurate look of inflation, because maybe inflation is actually better than the current readings that we're looking at today that's making us think we need to raise interest rates. So all in all, it was a new type of meeting. I mean, he didn't do a dot plot. He didn't say what's going to happen going forward, but you still had 3 members dissent and vote for a raise, and that also kind of spooked the market because the Fed was divided.
And Justin, tell the folks what the biggest concern out there still is regarding everything.
Inflation and tied to gas prices with Iran.
And the Iran conflict. So again, we say this every week, that continues to be the thorn in everyone's side because we don't know what the outcome is. We don't know how long this thing's going to last. But that is the number one thing out there right now, controlling this market, controlling interest rates. And we know interest rates, Justin, speak for everything.
Yep, the market doesn't like uncertainty, and unfortunately that's what we have right now until we get some direction on the Iran conflict.
So I hope you found this information useful. Again, if you have questions, please reach out. We hope you have a good weekend, and we look forward to seeing you here next week.
Have a great weekend.